welcome back to The Lens with Craig Shapiro and Larry McDonald. We miss you, so I hope you miss us too. We just came back from having multiple events in Puerto Rico, Bahamas, and Panama. Talking about events, we'll be hosting multiple events in Florida. The first week of December, we'll be in Tampa, in Palm Beach, Naples, and Larry will be at the Money Show Money Master Symposium in Sarasota on December 2nd. Get your tickets now in the link of the description below. And if you have any questions or if you'd like to join us for any of the previously mentioned events, reach us at info@thevirtualsreport.com. Right now, guys, we have a promotion going on for our book. We're back on the top 10, and right now you can get your Kindle version for just $1.99 up until November 9th. So go get yours now. Go ahead, guys.
Thanks, Val, and to the entire team in New York. Thanks so much for putting this together. It's great to be back with Craig. We took a couple weeks off. Craig, there's a lot going on today with liquidity. The last couple of weeks, the effective Fed funds rate broke that upper bound. There's been all this pressure. The Fed said we're going to stop QT December 1st. And ever since that moment, Craig, right, the beast in the market is kind of pushing the Fed. A lot of people are talking about liquidity. Tertiary assets have been underperforming established, whether it be with I don't want to say Bitcoin versus the other coins, the less established coins, and you go on and on and on. Tertiary assets underperforming. Craig, what stands out this week? You were talking about the whole credit market around CapEx and Oracle.
Yeah, it seems like a bit of a narrative shift going on in the AI CapEx story after Mag 7 reported pretty good numbers last week with CapEx moving higher, but then Meta and Google hitting the bond market to help finance some of this CapEx growth. And so I think the story on AI and on this CapEx is starting to shift a bit. These companies, were funding the CapEx growth from internally generated free cash flow, and that is starting to deteriorate. And so, the Mag 7 stocks were asset light, high returns on capital, strong free cash flow generation, return of cash to shareholders with share buybacks. That was the story for a while. And now increasingly they're becoming more asset heavy, returning less cash to shareholders, spending more on CapEx, and needing to hit the debt markets in order to help fund some of their growth. And so we saw Oracle, several weeks ago kind of gap up on big CapEx news, and now has completely filled the gap from that move higher. Its CDS spreads are starting to widen out a bit. Similar thing for Meta. I think both of those they're the two in the worst free cash flow situations here of the various hyperscalers. So again, I think that's shifting a little bit of the narrative here on the AI story. The other thing it's doing is, as more fixed income investment goes into the AI CapEx boom, it's going to be moving away from other areas of the market that need capital and need to refinance debt, whether it's small business lending, commercial real estate, maybe the mortgage market, right? So it's like the AI CapEx, and AI is kind of eating all the capital now. And so I think that's becoming, top of mind here for investors. And, they're definitely seeing that across the board in some of the weakness we've seen this week in the NASDAQ and in a bunch of these names. So I think that's an interesting dynamic that's been in play all week.
So we, as people know, we run a Bloomberg chat with hedge funds, mutual funds, and pension funds. We started in 2010, so it's a fantastic lens on a buy-side conversation with some of the most sophisticated, smartest investors in the world. And it's like a live ideas dinner where we're talking about things that are happening during the day. And then Craig runs the Discord room for people that are not on Bloomberg. Join us there. But one of the things that people have been talking about since last Thursday in the chat behind me is that when you don't prepare the street for size issuance in credit, so Meta essentially came to market with $30 billion of paper last Thursday, and then it was Google. And it really shocked investors because the bond market wasn't prepared for it. And if you look at the investment grade ETF, it's made this kind of like big move down, and it's shocked people. So in other words, in the investment grade market, when say $47 billion of paper comes to market very fast, that wasn't expected, the CFOs of Meta and Google should have prepared the street for this, but they did a flyby offering at $47 billion, much bigger than expected. And so people that own investment grade bonds to really get ready for this new supply had to sell. And this is all part of that whole fleeting liquidity message as part of this segment. As you can see there, Oracle, one of the points that's been made to me, Craig, is that these are cash cow companies that are now becoming very capital intensive, right? And if you think of like the last 30 years, there's always a sector that's really healthy. And then all of a sudden, think of like energy from 2010 to 2014, healthy sector, and then levers up, right? And then becomes unhealthy. Think of the financial sector in say 2004, 5, 6, 7, 8. Very healthy sector, and then levered up and became unhealthy. And now we have investment grade companies in technology space, cash cow balance sheets, Craig. We talk about this in our book, How to Listen to Market Speak. Really strong companies that because of this CapEx overdose and this kind of black hole, now you're seeing cash cows becoming capital intensive businesses. Isn't that the message, Craig?
Yeah, I think that's I think you nailed it there. And look, these are going to be, this is a story that's going to play out over multiple years. This CapEx build out is here, it's coming, and the country and the administration have bought into the narrative of how important this is, and so I'd expect this to continue going on. The question is at what price, at what interest rate will this get done at? And then ultimately, what are the economics behind these investments? Will the returns be there? Will these be, profitable investments for these companies? I think the debt holders will, earning 5, 6, 7% on these bonds. I think those will be, money good. And you have trillions of dollars of market cap ahead of you there in case there's issues. But again, I think from a crowding out perspective, you go from being able to fund all this growth with free cash flow generation to increasingly needing to fund it with the debt markets. It changes the story, right? It changes the narrative. And, you go from asset light, high return businesses that return cash to shareholders to asset heavy, debt financed, return less cash to shareholder businesses. The multiple is going to contract. And I think that's what we're going to see across the board here, in these names. The earnings may be fine. Time will tell. But multiples likely will come down as cost of capital rises as these companies become more heavily debt financed. And then for the rest of the economy that has benefited from liquidity largesse as more money goes in to fund AI capex. And it's not just these two companies too. OpenAI has a ton of debt that needs to get raised in order to fulfill their plans of $1 trillion or so of spending that's going to come over the next several years. So the rest of the economy that needs capital is going to have a tougher time getting that capital for the low interest rates and the low credit spreads that it's been used to. And so we're starting to see that dynamic in play there as well with respect to spreads in some of the tertiary areas of the economy, whether it's private credit, student loans, ABS markets, and a variety of other places at the fringes of the credit markets where I see spreads are already starting to widen.
Yeah, I want to get to ABS next, but before we go, Craig, this is a good chart. One of our clients put it into the chat today. Remember, when you're in a government shutdown, right, the rule of thumb is it's a 0.25% of GDP per week of economic loss. Now, the pressure, this chart shows the pressure that's going to build on the White House. Because if you think about it, it's not really a 0.25% per week. That's an average. It's really much less than that in the first week, but exponentially more than that in the second, third, and fourth week. And this is cumulative missing paychecks. And so you can see here, if once you go past 4 or 5 weeks of a government shutdown, it exponentially hurts the economy. It's like literally tentacles spreading at 5 miles an hour out to 150 miles an hour. And the White House, I think there's got to be a deal sometime in the next 3-4 days because we're talking about big hits to GDP from this point forward. And you can see this in the cumulative missing paychecks. Thoughts on the shutdown, Craig?
Yeah, look, I think the shutdown became much more top of mind for investors as we pushed through the week. Clearly, really it started on Tuesday night with the election results. I mean, we saw how Democrats were able to capitalize on the inability of the Trump administration to handle affordability and kind of catching blame for the shutdown and the wins in New York, Virginia, New Jersey, California really showed a shift in the populace back towards the left again here too. And so then you start to think about, okay, what could Trump do about it? And the government is still closed. And so Republicans are polling pretty poorly with respect to the government, and so how are they gonna open here? And look, I think Democrats are kind of digging in their heels here. They're not catching blame for this, but you're right. As we continue to move through, and I think that's been some of the weakness over the course of the last, let's say, 24 hours. Is, are we going to get a deal this weekend? John Thune is out saying they're willing to kind of deal with Democrats if they open the government, but Democrats just really are they don't want promises, they want actual results. And it seems like we need to get real structural change on these ACA mandates and healthcare spending before Democrats are willing to move here. I think the market is getting more concerned about this. I think that's why the VIX has become more elevated as we push through the week. And it seems like we're into one of those situations where if we don't get the government open over the weekend, then we start next week in another risk off position, and we kind of move, we move asset prices lower again in order to force the administration to meet Democrats where they are.
Right. And now, but before the shutdown, Craig, we have REITs, right? So real estate investment trusts and regional banks. At least 30 to 40 real estate investment trusts and regional banks are down 20, 30%. And most of that's in the last like 3-4 weeks. So there was already a structural commercial real estate thing developing. And then you think of like student loans or auto loans. This is a chart. That gold line there is asset-backed securities. So if you think about securitization, we talked about this in our first book, The Colossal Failure of Common Sense. That was a New York Times bestseller about Lehman Brothers. But the securitization machine is like a conveyor belt. And if spreads are blowing out in asset-backed securities, then that whole securitization machine slows down. And this is really important to track. So that's high yield in white, high yield bond spreads in white versus ABS. And so I think the problems in auto loans and some of the parts of the credit markets and liquidity has been spreading over. That's why you can see auto finance companies are way down, and everyone knows delinquencies are up. But I find it very interesting. This is the first time we've seen a real divergence, Craig, from the ABS spreads on securitizations and ABS versus the high yield market.
Look, I think even before the government shutdown, we knew that the lower part of the K-shaped economy was struggling already. Low-end consumers, small businesses, we're having trouble in this economy, and there's plenty of end markets that had been struggling. Restaurants, travel and leisure, consumer staples, and a variety of places as low-end consumer is feeling real wage pinch, elevated inflation, deteriorating prospects in the labor market. And then when you add on the government shutdown, not only do we not have the data to give us a real-time, look at how the slowdown in the labor market is taking place, but you actually have, workers that are out, in federal government workers who are not, contributing or not participating as much now in the economy as they're off. And now it's broadening out with these airline issues. And if we're forced to take down capacity by 5-10%, you're going to have less flights, less people flying, less work at these. So yeah, this becomes a cascade. And so you're adding more fuel to this fire with respect to spreads. And then you combine that with this dynamic that we discussed at the onset with the AI CapEx, you're putting more capital into that segment of the economy that had been traditionally funded, let's say from equity or free cash flow generation. The strain on the ability for the non-AI parts of the economy to grab capital now is growing. And so cost of capital is rising across the board for really anybody for really everybody, but specifically for people that are outside of the AI CapEx chain. And those are the more levered parts of the economy already. I think that the credit markets, the tertiary financials have been picking up on that dynamic.
So this is important. Credit typically leads equities. We find it really interesting that equities have been making new highs for weeks and weeks and weeks. But why are high yield spreads way, way above those tights? You see the bottom part of the chart there? So something's going on where high yield's not confirming the highs in equities. Whereas all last 2 years, high yield was constantly confirming, as you can see, as the stock market made new highs, the bottom part of that chart, all you see those arrows, the high yield market was going tighter and tighter and tighter. every time the stock market made a new high in 2024 and a lot of 25. And now here we are a lot wider with the market at all-time highs earlier this week. So I think that kind of gets
Yeah. I
that
mean,
kind
I
of
think I really think you could almost look there at the low in spreads was about a week before Oracle decided to do its bond deal, right? I mean, it was really so if you really think about this narrative shift, right? It's again, we do a lot of 1+1+1=10 type, connecting the dots in the chat, talking to different clients around the world as far as, what they're thinking and thinking. And so, as the narrative starts to shift on this AI capex story and the need for capital goes from, free cash flow generation and internally generated cash generation and equity to debt, it changed things, right? And the numbers are enormous, right? And the government is promoting this, and these companies are announcing $100 billion deals, at daily. It seemed there for a while, and so the numbers are huge, and the rest of the economy also needs capital. And so we have this divergent economy. We have this divergent market as well. And so the stock market, which is built on passive flows, we've been talking about this for forever. You don't see it in the overall S&P because of the high composition of these Mag 7 and related companies. But under the hood, dispersion had been, very high. Correlations were very low. Increasingly, the new lows list has been rising over the course of the last several weeks. And we may have a chart on that in here, but so we've already seen a lot of divergence, and the credit markets, I think, we're signaling that in advance, right? Credit not making new tights with the equity market moving new highs, I think was a good tell. And now you're seeing credit widening out again, which is, I think, indicative of this slowdown and this crowding out and this government shutdown that's going on. And so we're in a seasonally strong period, but the market not really particularly acting like it.
right.
The last 7 days.
And we were talking about tertiary names versus established. So the meme stocks, you're just talking about. You notice that leg down, I guess earlier in the year, like January. You can see there in the middle of the screen, like it's fascinating that in one of our we're at an ideas dinner in California in San Francisco, and we talked to a large hedge fund that manages money for one of the largest tech families in the valley there, and they track tertiary, like they track like 17 verticals of tertiary assets versus established. As one of them is this meme stocks versus S&P. And as you can see here, it's really a great measure, Craig. It's a great measure of liquidity, because when liquidity recedes, that's when the shit coins start to underperform the meme stocks, the profitless stocks, right? So during the day in the chat, when you're running the Discord room, you're constantly monitoring these things. How do you explain how you help our clients in the chat?
Yeah, and with respect to this, I mean, I'm looking at a variety of different baskets. Whether this one's a UBS basket, there's a bunch of Goldman baskets, the most short basket, meme stock baskets, a variety of these baskets that the street has created for investors to play on various themes or various factor exposures. There's momentum baskets, value, growth, quality, all sorts of things. And it's a reminder that not everything that's moving an individual stock in any particular day has anything to do with the fundamentals of, the company. There's a variety of different factors in play here, whether it's the macro factors or the beta factors or the style factors. And so, and Wall Street has divvied up a lot of these factor risks, and you could play baskets of them. You could play, tariff winners, tariff losers, right? And so,
right,
plenty of things going on here. But we do monitor a lot of these things, and what we like to, when we see these divergences, right? When we see the most short baskets starting to fall, when we see the meme stock baskets, the quantum names, the crypto miners, the AI capex, the rare earth names, the uranium names, when they start to struggle, right? That's been the area. The non-profitable tech companies. That's been the laggards, right? I mean, you at the beginning parts of these rallies, were played with Nvidia and the Mag 7, and then as people get, you get later into the rally, people are looking for catch-up trades. We kind of went through that period here through the summer, through the third quarter, with blow-off tops across a variety of these subsectors, and now we're starting to trade the other side of that as liquidity is being withdrawn. The government shutdown has a little bit to do with that. The TGA has been built.
And that's the Treasury General Account, right? That's the Treasury checking account.
So the government's not putting, let's say, $5, $6, $7 billion a week into the economy, and so banks don't have access to that capital, and so they've been forced to hit, the standing repo facility, particularly into.
So explain that. So the bigger the Treasury General Account is, that's money that's not It's
Yeah,
kind of been pulled out.
it's money that's not filtering in the economy, and the velocity of that money is becoming stagnant because it's just sitting in the treasury checking account.
So as they collect tax receipts, the Treasury general account goes up.
Right, and they're not spending. Right, that's the issue. The issue now is that they're not spending. They continue to borrow. There's been plenty of bills auctions. They front loaded some of that, and so we'll see the Treasury general account will start to deplete here, even with the government being shut down, because there'll be less bills issuance as we push through the end of this month and into next month. But it has starved the banking sector from some capital. In a time of year where they need capital, with the economy starting to show some signs of stray. And so collateral values are falling. Banks are starting to retrench a little bit. And so I think we're getting some of that cascading effect here that's hurting the areas of the markets that really need more liquidity in order to keep going. Another area where you're definitely seeing that is in crypto. I mean, Bitcoin has been a big underperformer here over the course of the last couple of weeks. It's kind of broken down here, through the 150 days.
And once again, Greg, less liquidity hits Bitcoin, it hits the tertiary coins.
It hits the altcoins first, but it's definitely hit Bitcoin this time too, down 20+% from the high set only a few weeks ago here. And the seasonals for Bitcoin are very strong, October, November, and December, and so far not so good.
And the new lows. What's interesting here, Craig, is so you can't see the numbers, but I'll read you the numbers. So on the far right corner of the chart there, that circle, we've had probably 6 days above 80 new lows. So it's 80 to 120. It's a 124 yesterday, with the stock market really at all-time highs. That has not happened since April. And remember April, we were in this really bad risk off because of tariffs. Yeah, so that's once again, the breadth is breaking down. So 80 to 120 new lows on the NYSE, with the S&P at all-time highs.
Yeah, there are some there's some scary terms that people throw around here for various technical indicators, like the Hindenburg omen or the Titanic omen.
So the Hindenburg, what is that? The new
these are basically max dispersion indicators, right? This is a situations where there is only a few stocks that is holding up support for indexes, while there are several stocks that are really, really breaking down. And so then the question is, will the liquidity in the markets take the underperforming stocks and bring them back up to where the good stocks are? Or does liquidity moving out kind of take the good stocks and kind of bring them down? And that's ultimately a question for the Fed and for the Treasury. And so right now, what we learned from Powell last week was that, look, the Fed's really not going out on a limb here to say that the December rate cut is a done deal. And Powell pushed back pretty aggressively in the press conference to try to move the odds of a December rate cut from a virtual certainty to something less than a virtual certainty. So that on the margin has withdrawn liquidity. And with respect to the Treasury, with the government shut, the Treasury is just not really able to add liquidity right now. So you have a situation where these Hindenburg omens could become foreboding tales of where the market becomes, because we know that it's a sign of stress, it's a sign of strain, it's a sign of dispersion, it's a sign of there's crazy things going on in the market. And if we start to see liquidity contract, the winners will start to get sold, right? And into mutual fund year end, which is for October 31st. Many of those stocks kind of hung in there. Likely going to see many of these stocks really try to be hung in for the end of the year, because people don't want to pay taxes on winners.
Yeah, so let's get into tax loss selling here. So,
yeah, I mean, it's we definitely have a dynamic in play where, because of the dispersion that we've had all year, we've had lots of stocks that have done incredibly well and many stocks that have done incredibly poorly. You often see a crescendo of that dynamic into October 31st because of mutual fund year-end type dynamics. I think this year.
So explain that. The mutual funds want to they want to get the losers off the pad. They want to take the loss.
That's right. There's many mutual funds that have October year ends, and so there's often a dynamic in play where they're holding winners into that period and they're selling losers into the end of October, and you sometimes see the end of that dynamic as you push through November and December, and a lot of times those losers start to outperform in the last 2 months of the year in anticipation of outperforming next year when people start to really sell their winners. The question now, I think, though, is we're starting to see an issue here with, will people just keep, are people really going to want to rotate into that stuff into year end, right? You still can, there's still plenty of capital out there that's not in mutual funds that just plays for December 31st. And so I'm not advocating that we kind of go all in on these tax loss names. I think you have a couple up here, these cruise lines and some of the retail names. I think these are things we're thinking about getting into as you kind of really move through the end of this year and into next year.
Yeah, it's interesting that you got regional banks, so weak restaurants. There's like 30 restaurants that are down more than 20%. Cruise lines. So we've got this, like, that's the classic K-shaped economy. But today, Expedia, great numbers. Airbnb, great numbers. And if you really look into the calls, I looked at both calls. We were on both. We had analysts on both calls, and there really was a lot of decent things happening inside of both companies. But then you look at Chipotle, or you listen to the cruise lines. There's weakness in restaurants. Chipotle, dramatic. Like, talking about traffic from younger consumers. And so, this classic, it's massive head fakes from economic data. I've never seen anything like
Yeah.
it in my life. I've been in business 40 years. I've
Yep.
never seen anything like it.
I think this is the most bifurcated economy we've seen in, probably since the late 90s and to some degree, although even in the late 90s, in 1999 and 2000, the underlying economy was in a much better place. The government was in a much better place, in a surplus position. There is more strain in an increasing large swath of sectors, right? Whether it's in travel and leisure, in restaurants, in low-end consumer related, in housing, in autos, right? Anything away from the AI capex build out and boom is really starting to struggle. And I think this dynamic of the president and the administration putting on tariffs to try to bring back manufacturing jobs to America, so far really hasn't done a lot of what it was supposed to do outside of the AI capex. I think it seems like, a large preponderance of the 17 plus trillion dollars of investments are really going into AI capex and the data center story. And the question is, what are the returns associated with that? And will those investments be inflationary before they are deflationary, right? They are
Right.
going to be taxing the power grid. They are going to be taxing, by taxing meaning a big burden on the power grid. It's going to be higher power costs, higher water costs, higher construction costs, just inflation to build all that out at a time when the consumer really is struggling with the wallet share. So, more of the consumer spending, thankfully oil prices have remained under pressure. If we see an oil price spike for some reason, watch out, because that's another strain on the consumer wallet. But yeah, to your point, I think the economy is so bifurcated right now into year end here, and with this government shutdown, getting into its sixth week. I mean, is Christmas canceled? I don't know. I mean, it's becoming it's becoming something that people
So,
are thinking more about.
so think about Zion's, Western Alliance, both made comments. So two regional banks have been hammered about commercial real estate. And I think what's happening is I'm talking to a lot of institutional clients that track, the pressure of rates. And as inflation bounces and it's preventing more cuts, right? So a lot of people thought the December cut was automatic, right, on autopilot. And now, because less, this it's not like inflation is back to the highs, but it's sticky and it's not falling fast enough to allow, as your point, core, super core, right, which is still almost a percent and a half above like the 20-year mean, right? So, well, think of what that does to REITs, because the investors in the real estate investment trust space have been waiting for these rate cuts, right? Because higher rates are crushing these properties. I mean, a lot of these commercial real estate loans were financed at 2-3%, and now they're refinancing at 6, 7, 8, 9%.
Yep.
And so, as you can see there, it's devastating, and that's why if inflation doesn't come down, there's certain sectors that are just going to be in more and more pain.
Yeah, look, it's a two-tiered economy with one interest rate, right? And so the Fed's really having a tough time figuring out how to bring down
That's a
borrowing.
great line, Craig. Yeah, two-tiered economy with one interest rate.
Yeah, so the Fed's struggling to figure out a proper way to bring down borrowing costs for the folks that need it, whether it's the low-end consumer, small business, commercial real estate, levered parts of the economy. The Fed wants to bring down rates for that cohort of the economy because financial conditions are restrictive for that part of the economy. But for the parts of the economy, the wealthy and the AI capex parts of the economy, financial conditions are incredibly loose. And so the Fed is really struggling with this dynamic. If it brings down rates too rapidly, it creates an inflationary situation and becomes self-defeating. And I think the Fed is really struggling with delivering that kind of message. And so I think what you're seeing now is some pushback by the hawks and the Fed, whether it's the dissent from Schmidt, and we know Hammock and Logan are voters next year who are going to be dissenting voters because they're more cognizant of the inflationary issues. They also see wealth effect, loose financial market, high financial markets being incredibly stimulative for the overall economy. And I think that's what we have. You can't have if you have 4% GDP in the third quarter with an increasingly weak labor market, you're having some trouble there.
And one of the things we talk about in the book, How to Listen to Market Speak, is copper. Copper names are 3 times better performing than the NASDAQ this year. 3x, right? And so we talk about in the book robotics. We talk about this a lot of podcasts. Like you said, rebuilding the power grid, data centers, the construction of just one data center. Think of the copper. Think of the copper in there. And so I think one of the big things that I'm seeing on the institutional side is that a number of people that were really bullish Meta, really bullish Nvidia, are now far more interested in the copper names and the coal names and the natural gas names that are going to really support the power infrastructure for AI. And it's like the first leg of the trade was obviously chips and Nvidia, and now we're seeing the thing broaden out dramatically. And this chart shows, copper names just destroying the Qs this year.
Yeah, I think we were we were early in that, and you were early with the book, just kind of understanding that dynamic. And I think here on a check back here in markets, as we think about, what's going to work for next year, where is the earnings growth acceleration going to be? It's going to be in companies that really sell into the AI CapEx build out. And so whether it's natural gas related or commodity copper related names that we know demand trends are moving higher, supplies are constrained. And so, and we know, from a percentage of overall market cap perspective, these sectors are very underowned. And so a little bit of market cap out of the NVIDIAs and the Metas of the world can go a long way for some of these beaten down commodity related sectors.
Yeah. And the thing about, gold there's been this really debate where gold's been so overbought, like the percentage of gold above the 50-day moving average 4 weeks ago was like one of the most crazy overbought periods ever. But as you can see here, precious metals as a percentage of household wealth, or precious metals versus the S&P, are still nowhere near where they've been. I mean, we're talking way. I mean, this chart's, I think, a beautiful chart because it shows, like, in terms of like representation in the S&P 500 for hard assets, it's still a complete and utter joke, right? And so once we move into that elevated inflation regime with higher bond yields and more sticky inflation, what happens is every day, every week, every month that rates are up here and inflation sticky, it moves money out of financial assets, which are just paper certificates, over toward hard assets. And that's what's been happening here. You can see the S&P versus gold.
Yeah, I think the story for gold remains a good one for next year. And to the extent that we have any a much more protracted slowdown or recessionary dynamics in an increasing part of the economy, I think the government's going to have to react to that with in some way, whether it's these ACA funding for healthcare, and it's going to be deficit expanding, right? The government has talked about and has done a decent job here slowing down the pace of deficit spending growth this year, and the bond market has reacted accordingly and has rallied on back of that in part. But to the extent that the economy shows more signs of sluggishness, the government's going to be forced into a situation where deficit expansion is going to become more likely in the next budget, particularly into the midterms, as if Trump is desirous of trying to keep power, which I suspect he is.
Well, great, Craig. I can't wait to see you. You spend more time in Naples, right, than Tampa, right? So
that's right. Yep.
So I want to do a nice, and thanks, you picked out some really nice spots, and I wanted to thank you for that. Craig's helping us because what we do is we're speaking at the Money Show. There's a lot of very big audience there. It's the Money Show team. We worked with them. We did the keynote speech in Vegas, and then what we do is we take some of the money that we earn on the speaking tour, we invest it back in the clients. And so we're going to do events in Tampa, Palm Beach, and Naples. And so you can reach out. And we're doing book signing, cocktails. You can reach out to Valentina or the team on our website, info@thebeartrapsreport.com. If you're in the area, we're happy to sign some books. The events are really for clients, but we'll do some book signings in those three cities. And the book has been in the top 10 all week. I'm so grateful to everyone. The paperback's coming out next month, and so the book tour is pretty much over. This is the last three stops. So, Craig, we're going to end the year with you, baby.
Sounds
look
good.
forward to
Yeah,
look forward to seeing you.
absolutely. Weather's usually pretty good down here in Southwest Florida in December. So looking forward to having you down here.
Okay, thanks, Craig.
Sounds good.
Have a
Thanks,
great
Larry.
weekend.
All right, you too.
Thank you, Craig. Thank you, Larry. And thank you, everybody, for joining us this week. As Larry said, this is the last stop for the book. So you have to join us. Tampa, Naples, Palm Beach, if you're in the area. Also, Sarasota, Money Show, Money Master. If you're interested in joining us and seeing Larry giving the keynote speech, you can reach out to us. We have a special link just for you. Back in the top 10. And remember, until November 9th, you can get your Kindle version for just $1.99. Thank you so much for the support, and we'll see you next week. Bye.